Hello everyone, and welcome to another edition of IronFX Viewpoint. I'm Marshall Gittler, Head of Global FX Strategy here at IronFX. Today, we're going to talk about the euro. The euro is in serious trouble. Not so long ago, EC President Draghi was talking about positive contagion spreading from one country to another as the situation in the peripheral countries seemed to improve. But it turns out that only the financial indicators were improving. The real economy in these countries continued to do poorly. Add to that a disappointing Italian election, and it looks to me like the euro's holiday period is coming to an end. Draghi's comments were based on the fall in bond yields in some of the peripheral countries. And indeed, if we look at Italy, the green line, and Spain, the silver line, yields there have fallen to about half of their peak levels, which does suggest that investors are more comfortable with the outlook for these countries. Even in troubled Greece, 10-year yields have plunged from a staggering 37% to 11%. That's a huge improvement. That clearly shows an improvement in investors' confidence. But is that confidence justified? In fact, even while bond yields were coming down, the peripheral countries' debt-to-GDP ratios continued to go up, partly because their debt continues to grow, and partly because their GDP continues to shrink. We can see from looking at the nominal GDP data that while the Eurozone as a whole, the red line, has recovered to its pre-crash levels and continued to gain, there's a big gap among countries. France, the yellow line, and Germany, the dark blue line, are growing. But Italy, the green line, and Spain, the silver line, have yet to recover even to their pre-crash levels. And we don't even dare think about Greece, the light blue line that's falling off the bottom of the graph. The IMF forecasts that the Spanish economy will shrink 1.5% this year, a bit worse than last year, and that Italy will contract by 1%, which is an improvement from minus 2.1% last year, but is still pretty bad. They don't see either economy growing until next year. We get a similar picture with employment. Unemployment in Germany, the dark blue line, has come down, but in Spain, the silver line, and in Greece, the light blue line, it's over 25%. 25%! It's getting so bad that people are leaving these countries. And of course, the people who can leave are the most educated ones, the very people whom these countries can least afford to lose. This will damage these countries' growth prospects for years to come. Finally, I just want to show you this graph of bankruptcies in Spain. It's incredible. From 2002 to 2007, they averaged about 2 million euros a quarter. In the fourth quarter of last year, they were 2.3 billion euros, nearly 12 times as high. The country still has hundreds of thousands, maybe over 1 million unsold houses. So, even though the financial picture has improved a lot, the economic facts are still pretty bad in the peripheral Eurozone countries. And now we have the election fiasco in Italy. Well, Mr. Bersani won the lower house, former Prime Minister Berlusconi won the upper house. That makes it impossible to run the country, since any bills have to pass in both houses. We're going to have several weeks of uncertainty while the politicians try to figure out what to do, whether to have new elections, form a coalition government, or whatever. And markets don't like uncertainty. That's probably bad for the euro. While it wasn't clear who won the elections, it was definitely clear who lost. Former Prime Minister Monti lost, and the EU political establishment lost. More than half the voters rejected Monti and his policy of austerity and reform. In effect, they were voting against German Chancellor Merkel and the policies imposed on Italy by Brussels. They were voting against the euro. This rejection poses a huge test for the Eurozone. Mr. Draghi has said that the ECB would do whatever is necessary to keep the Eurozone intact. And that's why peripheral bond yields came down to more sustainable levels. But what will he do if one of the countries refuses to do what's necessary? His offer to buy bonds of a troubled country came with strict and effective conditionality. In other words, if you want ECB money, you have to institute ECB policies. But what will they do if the politicians just say no to those policies? Germany's been moving slowly towards agreeing on debt mutualization, which is a necessary step if the euro is to be made secure. But will Mrs. Merkel still be willing to bail out Italy, or Greece, or Portugal, or Spain for that matter, if they refuse to go along with Germany's preconditions? This is a huge issue, and we just don't know the answer. That's why I think the Italian election is a major turning point for the Eurozone, and of course, for the Euro as well. Generally speaking, the election has created uncertainty about Italy, the largest of the troubled peripheral countries, and markets don't like uncertainty. I think from a fundamental point of view, this reinforces our view that Eurodollar is headed lower. And for the near-term technical view, I'll turn the show over to my colleague, Antipas Asfour.
Thank you, Marshall. On the 20th of February, Euro-USD broke down from its strong support area of 133-1332, which congregated the 23.6% Fibonacci retracement level of the July-February uptrend, the trendline support from the July uptrend, the lower Bollinger Band, and the 50-day moving average. This support level turned resistance thereafter, being severely tested on the 25th. The failure to break out, however, and the simultaneous breakdown from the downward sloping channel can be perceived as highly bearish signals, with subsequent targets being close to the next retracement levels. The downward sloping trading channel does not have the characteristics of a flag, since the downtrend is too steep and on high tick volume. This increases the likelihood that we are experiencing some sort of price reversal and not a mere continuation pattern. With 1332 as a noted strong support, and with my initial targets of 13116 and 1302 met, I see prices heading lower to 1291. With a probable 14-day stochastic crossover taking place in oversold territory on the daily chart, and with the RSI also in oversold levels, we may be seeing a rebound of some sort, but this is likely to be short-lived. Nonetheless, the weekly chart seems to confirm my longer-term bearish outlook, as the MACD is on the verge of giving a sell signal, with the stochastics currently in a steep decline. Longer-term traders may opt for the signals in the weekly chart, since they have proven somewhat more reliable than those on the daily charts. Now, back to Marshall for the closing comments.
Thank you, Antipas. So, that's our view. Fundamentally, the Eurozone economy remains in trouble, with the real economies of the peripheral countries showing nowhere near the kind of recovery that the financial indicators show. And to make matters worse, Italy, the largest of these troubled peripheral countries, has rejected the Eurozone consensus for dealing with its problems. That could raise questions in the market about just how far Germany and the ECB will go to keep the Eurozone together. We expect the markets to test their resolve at some point, which would mean a lower Eurodollar. Of course, don't just listen to what I have to say. You should read a lot of information from a variety of sources and listen to what a variety of people have to say before you make up your mind how to invest. It's your money. It should be your decision. Any questions, comments? Please feel free to message me at mgitler@ironfx.com or get in touch with your IronFX representative. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.